Introduced in 1999, the cash ISA quickly became one of the most popular savings tools in the UK, with around 7 million people subscribing to them in the 2022-2023 tax year, marking a 10% increase from the previous year. This suggests that many savers see value in using them, even as alternative options gain traction. On top of that, the total amount subscribed to ISAs in that year was approximately £72.2 billion, further highlighting their ongoing appeal. Now, out of those 7.9 million people, not one of them was me. I don't hold any money in a cash ISA, and I still don't plan to. Can 7 million people really be wrong? Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. Whenever you invest, your capital is at risk, and tax treatment depends on personal circumstances and may be subject to change. What is a cash ISA? A cash ISA, individual savings account, is a tax-free savings account available to UK residents. Unlike regular savings accounts, any interest earned in a cash ISA is completely free from income tax, making it an attractive option for those looking to maximise their savings. With an annual tax-free allowance, currently £20,000 per year, people see it as a smart way to shield their money from tax, especially before the introduction of the Personal Savings Allowance, the PSA, in 2016. Could cash ISAs disappear? There have been recent discussions in the media about whether cash ISAs are losing their relevance or could even be phased out. Recent reports suggest that some city firms are pushing for the government to cut tax breaks on cash ISAs to encourage people to invest in riskier assets like shares. The argument behind this proposal is that cash ISAs primarily benefit cautious savers, while the government and financial industry want to encourage greater investment in equities and other riskier assets. By reducing the incentives for people to keep money in cash ISAs, policymakers could push savers towards stocks and shares ISAs, or direct investment in companies, theoretically boosting the economy. This is obviously going to upset a lot of people dependent on cash ISAs. Personally, as I said in the intro, I don't have a cash ISA at all. I believe there are better alternatives that offer similar or even superior benefits depending on your financial situation. Let me explain what I mean. First, why do people use cash ISAs? To explain why I don't use it, first we need to assess why people do use it. So I asked on the Trading 212 community for your thoughts. Despite the changing financial landscape, from what I can gather from the responses, people still turn to cash ISAs for three main reasons. 1. Somewhere to keep cash. A cash ISA is seen as a safe place to store money, offering better returns than a standard current account. 2. Tax-free interest. Since interest earned in a cash ISA is never taxed, many people believe it's the best way to protect their savings from HMRC. And 3. Safer than a stocks and shares ISA. Unlike investing in a stocks and shares ISA, a cash ISA isn't exposed to market volatility, making it a relatively safer way to save than in stocks. While these arguments seem logical, I believe they don't hold up when compared to other options. And here's why. But before we go to the alternatives that I think supersede it, and while we're on the topic of Trading 212, a quick word from the sponsor of today's video, which incidentally is Trading 212. I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section. Capital at risk, terms apply. So if you opened a new account recently or planning to open an account, and then here it is, DivExp or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive free fractional shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading 212 for sponsoring this video. So are there better alternatives than a cash ISA? Here's my thoughts. First, the Personal Savings Allowance, the PSA, makes the tax benefit almost redundant. From the responses, it seemed like a few were not aware that UK taxpayers currently get a personal savings allowance. For basic rate taxpayers, the Personal Savings Allowance allows £1,000 of interest per year tax-free, and that's £500 for the higher rate taxpayers. At current savings rates, and for simplicity's sake, let's say around 5% in early 2025 when the video is being made, you'd need over £20,000 saved in a non-ISA account before even hitting the PSA limit, then £10,000 for the higher rate taxpayers. For most savers, this means that their regular savings is already tax-free, making a cash ISA's tax benefit unnecessary. Additionally, many high-interest savings accounts offer rates similar or better than cash ISAs, meaning that for higher savings amounts, the benefit of a cash ISA is minimal. Now, you might say, yes, I have more than £10,000 or £20,000 in my emergency fund, so I still need a cash ISA. Well, hear me out for my second point. premium bonds may offer better returns. Premium bonds are saving products where instead of earning regular interest, you're entered into a monthly prize draw for tax-free cash prizes. The effective prize fund rate is currently 4% as of Feb 2025, meaning that on average, premium bonds offer returns similar or slightly lower perhaps than cash ISAs. However, unlike a guaranteed interest rate, the returns depend on winning prizes, so people may earn less or nothing at all. The main advantage of premium bonds is their so-called guaranteed nature, as they are backed by the UK government and allow withdrawals at any time. Why premium bonds returns may be better than they seem. The returns from the premium bonds are tax-free, meaning that for higher rate taxpayers, the effective return can be even better than a regular savings account offering a similar rate. For example, if a higher rate taxpayer, the 40% tax bracket, has money in a standard savings account offering 5% interest, their after-tax return would only be 3%. However, a premium bond holder earning a 4% return keeps all of it, making it effectively better than a 5% taxable savings account for someone paying higher rate taxes. For people who prefer a bit of excitement and don't need a guaranteed return, premium bonds could be a more appealing option than a cash ISA. You might be saying now, okay, premium bonds having tax-free prizes is better, but we're talking about cash ISAs which are tax-free anyway. And here's the nuance I'd like to add. You're able to open and subscribe to both a cash ISA and a stocks and shares ISA in a tax year. However, the catch is that the £20,000 allowance is shared by both. I believe it's better to fully utilise this allowance in the stocks and shares ISA, and here's why. A stocks and shares ISA typically beats cash in the long run. Many people turn to cash ISAs because they want to avoid the risks associated with investing in stocks. However, investing over the long term has historically provided much better returns than savings in cash. Over the last several decades, stock markets have significantly outperformed cash savings, even accounting for market downturns. While investments do carry risks, holding cash also has a less visible and prominent risk. Inflation erodes the real value of your savings over time. A stocks and shares ISA allows you to invest in a diversified portfolio of shares, bonds and funds, helping to mitigate risk while still offering better potential returns than cash. You can invest in a stocks and shares ISA as well as a cash ISA on the platform of the sponsor of today's video, Trading 212. The impact of inflation on cash ISA returns. One of the biggest risks of keeping money in a cash ISA for the long term is inflation. Even if you're earning 4 to 5% interest per year, if inflation is running at a similar or higher rate, your real purchasing power isn't increasing. Inflation means that over time, the same amount of money will buy fewer goods and services. And if inflation is at 5% and your cash ISA is only paying you 4%, for example, your savings are actually losing value in real terms. Historically, stocks and other investments have outpaced inflation, while cash savings often fail to keep up. For those who don't need instant access to their funds, investing in assets that have historically outperformed inflation may be a better strategy than relying solely on a cash ISA. And here's a chart from Interactive Investors showing the long-term results of doing either saving as cash in orange and getting the interest rates, or investing in stocks, or in this case the FTSE All-Share Index. The blue is the contributions themselves without any growth. This chart highlights the power of long-term investing in stocks versus holding cash. While cash, represented by LIBOR rates, provides stability, it grows less significantly over time, whereas investing in the FTSE All-Share Index significantly outperforms despite periods of market volatility. The difference is staggering. By 2022, ISA contributions invested in stocks and shares had grown to £1.37 million compared to just £591,000 in cash investments, showing that even with the stock market crashes, long-term equity investing has historically been the best way to build wealth. This underscores the opportunity of holding too much in cash when investing for the future. Final thoughts. The cash ISA isn't completely irrelevant, but for many people it's possibly no longer the best choice. With the personal savings allowance covering most savers' tax needs, and other options like premium bonds and stocks and shares ISAs offering better potential returns, it might be time to rethink whether a cash ISA is truly worth it. For me, I aim to maximise my ISA allowance, but allocate all of that to stocks. The amount that I can put into premium bonds is more than enough as an emergency fund, and if I need cash at extremely short notice, i.e. shorter than the 3 working days from premium bonds, then I'm happy to use my personal allowance to receive interest outside of the ISA. Of course, this is all theoretical, and your own choice may be completely different. What about you? Do you own and subscribe to a cash ISA? If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!